And thank you all for joining us in this breakout session. We know you had options, and thank you for choosing this one. As Kelly mentioned, Zions Capital Markets is the capital markets and investment banking platform of Zions Bank Corporation. And our customer universe is really kind of a middle market focused customer universe. And our vision for that business has really been helping our clients who we know well meet capital providers that we know well. And that's sort of a barbell when you think about the New York Stock Exchange being on kind of the other side. And so we thought it'd be really interesting, in the context of having all these great, Utah business leaders here, and then a bunch of international capital providers in one place. What better way to celebrate that than talking about, what's probably the greatest symbol of American capitalism, the New York Stock Exchange, which last Friday celebrated its 232nd anniversary. So what does that make it, older than Utah? Yeah. Very, very impressive. So John is the vice chairman of the the NYSE group, and the president of the NYSE Institute. He oversees NYSE's global listings, global advisory, and exchange-traded products businesses, including managing the exchange's relationships with more than 2,400 companies located in 47 countries, and accounting for 43 million jobs. He also leads the NYSE Institute, which promotes the role of public markets in driving inclusive economic growth and ensuring the long-term competitiveness of the U.S. capital markets. Since joining the New York Stock Exchange in 2007, John has served in a succession of roles, including Chief Commercial Officer, Chief Operating Officer, Global Head of Listings, Chief of Staff, Head of Corporate Affairs, and is Managing Director of Global Affairs and Government Relations for NYSE Euronext, then the parent company of the New York Stock Exchange, as well as 5 other financial exchanges in Europe. And so I think that's going to be really relevant background, because John isn't just bringing the perspective of the United States. He's also been involved with exchanges in a variety of different sovereign regimes. John holds an MBA from the University of Notre Dame and a BBA from Eastern Michigan University. He's a point person for hosting international regulators and has even hosted presidents and prime ministers. He also regularly meets with the C-suite leaders of the Fortune 100. John is proud of his Michigan roots, which he has in common with our new CEO of Zions Bank, Paul Burtis. I hope all of you get a chance to meet with Paul as well. And thematically, he started his career in the public sector working in President Bush's White House. So the fact that President Bush is here today, I think, is a nice sort of connectivity. So please join me in welcoming John Tuttle. So John, I think everybody in the room's heard of the New York Stock Exchange because they picked our breakout session.
That's right.
But I doubt people have a full appreciation for its history, and at least when I think of the New York Stock Exchange, maybe relative to some competitors, I think of a rowdy trading floor as opposed to kind of a technology-driven platform. So maybe give us a little context of what is the history of the New York Stock Exchange, and what does it look like today?
Yeah, absolutely. Well, first and foremost, thank you so much for the opportunity to be here. Thank you very much to the Zions team. I have to say, I landed in Utah a couple of days ago. There wasn't a cloud in the sky. There was no traffic on the road, and the mountains, were just glowing in the sunset. And I called my wife. We have some young children. I said, I think we might need to move to Utah. So even in the first 5 minutes, the experience was incredible, and the hospitality has only continued since then as well, too. So you thought I was just coming for a day. I might be here permanently.
We'll take it.
All right. But thanks so much for the kind introduction, and thank you for joining this session as well. Maybe just a quick show of hands. How many of you have been to the New York Stock Exchange? Oh, all right, pretty good. How many of you have been there in the past 10 years, let's say? Or the back row, pretty heavy. Okay, great. Well, I'm a little biased. I say there's 4 buildings that define America: the White House, the Capitol, the Supreme Court, and the New York Stock Exchange. And it's a very special place. And probably 90 to maybe 99% of people you talk to on a given day forget or never knew that the first capital of the United States was not in Washington or Philadelphia, but right there in Lower Manhattan. So just across the street from where the exchange is today is the site of the first Capitol. That's where the State Department was founded, the Treasury Department was founded, Congress, Supreme Court met for the first time, the Bill of Rights was ratified, and in 1789, Washington was sworn in to become the first president. And so it's a narrative and a story I wish got out a little bit more, that our country and our markets, their histories are inextricably intertwined. They literally grew up next door to each other. And I'll try to give you about 232 years of history in about less than 2 minutes here. But But 1789, Washington's inaugurated. 1790, Alexander Hamilton, first Treasury Secretary, whole new wave of fame 200 years after his death, writes something called the First Report on the Public Credit. And essentially what it said was, all of these individual colonies are now states, almost all of them, many of them, were heavily in debt following the Revolutionary War. For the good of the country, for the good of the Union, let's nationalize this debt. It becomes the federal government's debt, and we create this national financial market infrastructure. So he writes this report in 1790. He walks up the street to see Jefferson, where he was officing, and he says, "I need you to go along with this plan." And Jefferson said, "Well, what's in it for me? I'm from Virginia." He says, "All right, I'll make you a deal. We'll move the capital to Virginia, and if you go along with this plan." So that's how the capital got to Washington, D.C., and that's how our capital markets in the United States were formed. So 1790, the plan goes through. 1791, the first tranche of U.S. Treasury bonds is issued, 5 to 5.5%. So, the more things change, the more they stay the same. But in 1792, and you mentioned Friday was the 232nd anniversary, 24 brokers that were trading bonds that had been issued by the newly formed government signed a very simple agreement saying they'd be fair with one another and they'd deal only with one another. And it was called the Buttonwood Agreement. And it was called that because they would trade under what was called the Buttonwood tree. And at that time and in that part of the country, that's what they called the sycamore tree, because literally they used its wood to make buttons for clothing and apparel. And those 24 brokers signing a 2-paragraph document gave rise to the New York Stock Exchange. And while so much has changed over 2 centuries, our core mission has remained the same. It's to help great companies do great things by being able to access capital that they can use to grow and expand a business, to launch new products, to tap into new geographies, and along the way create jobs and improve quality of life. But also, it's an opportunity for investors, so institutional investors like many in this room, or even individual investors, the ability to allocate their capital how they see fit, whether it's in pursuit of saving for their kids' education, their retirement, or even their own financial freedom. So while so much has changed over 2 centuries, how we do our job has evolved. So the New York Stock Exchange, for those of you that haven't been there in the past 20 years, more change has happened in the last 20 years than in the preceding 2 centuries. And all for the better, I would argue. And it was really driven by a couple of things. One was regulatory reform to bring increased competition into the space. The second was just technology started playing an ever-increasing role in market operations. So about 20 years ago, we had to make a decision. Are we going to evolve or are we going to die? And so we evolved, and we evolved a lot. In a short period of time, so think 2005, 6, 7, we went from being this quasi-member-owned, not-for-profit utility, hierarchical old boys club to being a for-profit, publicly traded, global, multi-asset class company. And the exchange industry is one where economies of scale kick in very quickly. At least in theory, you put 2 exchanges together, remove one fixed cost base, and realize your costs and revenue opportunities very quickly. And so we went out and pursued a strategy of globalization. I mean, we heard some of the earlier panelists talk about naive globalization. Hopefully it wasn't naive, but we pursued that strategy. And so we went out and we acquired exchanges in Paris, Lisbon, Brussels, Amsterdam. And this is when I joined the exchange. I came from the State Department in Washington. I was in the Bush White House before that. And we quickly realized that every country has a flag, an army, an airline, and a stock exchange. So there's a lot of national pride that goes along with it. And if you can work your way down the food chain rather than up it when dealing with policymakers and regulators, you're going to be more effective in implementing your strategy. So we did that. And then, fast forward a decade, we were the target of an acquisition for the first time in over 200 years. A small company founded out of a founder's spare bedroom called Intercontinental Exchange made a bid for us over a decade ago. And after a year's worth of regulatory hurdles and a lot of money spent on advisors, we closed the deal. But now the New York Stock Exchange, more broadly ICE, we own 13 exchanges around the world. So we're the world's largest equities exchange. We're one of the world's largest commodities exchanges, so we're the world's largest exchange for soft commodities, so think coffee, sugar, cotton, cocoa, orange juice. We're the world's largest exchange for energy, so the Brent oil contract, natural gas, renewables, world's largest renewables exchange for the short end of the yield curve, so financial futures there. And we've thought, how can we take this playbook, similar to what many of you are doing in your businesses, of leveraging technology to bring transparency, efficiency, accessibility to parts of the marketplace that have traditionally been opaque, paper-heavy, highly fragmented, lots of intermediation. And so while there's very little room for any more horizontal consolidation in the exchange space because of antitrust concerns, there are opportunities to bring this playbook to other parts of the market. So we operate a market data business, which is about a $2.5 billion top line for us. And now we've just gone in very, very big on modernizing the U.S. mortgage market infrastructure. And it sounds like a departure, but it actually is very closely tied to our core business. You could push a button on your phone, Mike, and get a loan for $50,000 like that these days. But if you want to get a $50,000 mortgage, maybe not in Utah, but in most of this country, if you want to get a $50,000 mortgage, it's 9 weeks and a wet signature and $18,000 worth of friction that's in there. And we thought, how can we shorten the line from A to B? People don't want a mortgage, they want a house. How can we bring more transparency and risk controls in there as well? So we've made a big, and by big I mean $25 billion investment in modernizing that mortgage market infrastructure. So really so much change has happened in the past 20 years. And like I said, all for the better and all meant to really leverage technology to bring more access to more opportunity for more people, which is always a recipe for delivering better outcomes.
I mean, that's remarkable. And just to think about the hollowed grail that is so, fundamental to our country is pretty incredible. I also hope that if you do get a mortgage, you call Zions Bank in Utah. But, so the stock exchange in of itself, I think, is really amazing. But let's talk about kind of the markets that it provides access to. And you mentioned earlier that you have experience with some exchanges internationally. There's obviously differences in economies and differences in kind of the companies there and the capital providers there. But what are some of the kind of basic, whether it's rules, regulations, norms, what are some of the things that differentiate the American capital markets from, those in Europe or North Africa or wherever?
Yeah, it's a great question. And let there be no doubt, the U.S. capital markets are the envy of the world. They are the deepest pool of liquidity. They're the broadest investor base that's out there. We have rule of law and governance that many other countries don't even come close to. Now, the U.S. market, global markets, to your point, they're sufficient for local companies in many cases. There are plenty of companies around the world that don't need access, don't need to come to New York to access capital. But what we're seeing right now is really playing out in Europe, and particularly in London post-Brexit, is that if you don't work to nurture and cultivate and evolve your marketplace, that capital and those companies will move somewhere else. And by that I mean, if I look to London, I think, which 15 years ago, if we were having this conversation, you'd be saying, how do you protect yourself against London's advance? What you've seen is a series of missteps, which has caused that, which they're working hard to try to reverse. And liquidity is a positive feedback loop. The more liquidity you have, the more it brings more additional liquidity. And the opposite is also true. And so for companies around the world, why are the U.S. capital markets the destination of choice versus London or Singapore or Hong Kong or Abu Dhabi or anywhere like that? It is that deep pool of liquidity that's there. So the ability to raise capital that you can use to fund the business. Number two is we have many of the brightest minds in finance, at least, focused on the marketplace. And by that I mean with analyst coverage. If you go to the UK, if you go to other parts of the world, and I don't mean I love the United Kingdom, it's a great place, but when it comes to their analyst coverage, there's nowhere near the United States. If you operate specialized businesses, you're a biotech company, life sciences company, technology company, you have very, very specialized analyst coverage in the United States. Analysts that understand your business, can provide you feedback, can communicate the opportunity to the marketplace, where other markets are just generalists. When you look at rule of law, the ability to have a bankruptcy code, the ability to have a properly regulated markets by our principal regulator, the SEC, that brings confidence, and confidence brings capital. And so, what we need to make sure we're focused on, and this is why we launched the NYSE Institute, our public policy arm, almost 2 years ago, is that we have a beautiful, beautiful thing here. And we need to make sure we're cultivating it and that policymakers in Washington and around the world understand the important role that public markets and capital markets more broadly play in driving inclusive economic growth. We need to make sure that, there are benefits and burdens that come along with being a public company. And, there is costs, there are headaches that can come along with it, but we need to make sure those scales are in balance and we're not putting more and more weights on the side of burden, which makes other options which have emerged over the past decade even more attractive. Now, look, private capital is going to be out there, whether it be from private equity, family offices, and all that. And companies are going to make the right choices for themselves. But you see new funding sources like the sovereign wealth funds out of the Middle East or in Southeast Asia that are flush with cash and have to deploy it. And I want to make sure that as a company who's growing and creating jobs and is entering probably the steepest part of its growth curve, when they think to finance their businesses, they have options. They can go private equity, fine. They can look at the public markets, which I believe brings the most people along with them on that journey, but it also gives them access to capital at market rates, and not just equity capital, converts and debt, but they can also get a check from one of the sovereign wealth funds and not have to worry about meeting the quarter and having all the operational and governance and financial discipline that you have. I want to make sure that this public markets option is the most attractive one when companies have to select which path forward.
That's great, and look, there's a lot to unpack there. But one of the things that I'm hearing as a theme is sort of access and democratization of participating in the growth of these great companies. So I think there's the obvious. Okay, well, if you have a public company, mechanically, it's easier to buy a share in that company, and that's a critical thing that the New York Stock Exchange does. But I think it's maybe the connection to the equity analyst coverage is a little bit less obvious. I'm glad you brought that up. Right, it's one thing to be able to buy a share, but it's another thing to be able to understand what you're buying and the risks that you're taking. And I think having coverage from experts that can be widely available just broadens that access to prudent investing. So I think that's great. You also talked about the private markets versus the public markets, and most of our business designs capital markets, as I mentioned earlier, is in the private markets. So those of you here that are capital providers, I've got to do a shameless plug here. We've got thousands of business customers that someday are going to need to raise capital, and someday they're going to need to transition. And in Zion's capital markets, that's really what we do. So those of you that are interested in investing directly in Utah, please call me. Those of you that would like to buy shares and probably better vetted, better covered by the analyst community companies, New York Stock Exchange. Anyway, so you talked about formation of capital. And obviously in your role, you're meeting with the decision makers that drive this, right? And so what are some of the things that you feel like, whether it's our regulatory community or international, that you need to promote and or resist a little bit on behalf of our marketplace?
No, it's a good question, and what I'm about to say is kind of my view, not necessarily the House view.
Right. Check.
But look, we need to make sure that our regulatory environment evolves to meet market dynamics. We need to make sure that the burden of being a public company with regard to the level of liability that's brought on officers and directors of a company is appropriate. Because right now, in my view, we have a marketplace that works fantastic for large companies. They can access debt at the rate of almost U.S. Treasuries. The cost for them to comply with U.S. securities laws is much smaller. And they're already disclosing a lot of the information around things like ESG and greenhouse gases and all that. We have a system, though, that in my view is right now disproportionately punitive to small to medium-sized issuers, and those are the ones that are creating the jobs, investing a lot of capital, and are delivering a lot of growth to the marketplace. So we're constantly in dialogue with the regulators to make sure they're hearing that feedback from our public companies, the ones that are deploying capital into the marketplace, that are making the investments, and providing them with specific recommendations on everything from proxy advisor reform to transforming disclosure regimes, et cetera. But I do want to say, with regard to the private markets versus the public markets, I think the work you do and the work we do are not in conflict. They're very much complementary. And the work you do in providing companies access to capital at a time in their life cycle only potentially accelerates their timeline to the public markets.
I think that's right. I mean, I think there's a growth progression, and there's a critical mass that you really need. And what we try to do is help companies that in some instances we've banked for generations go through that growth trajectory and really kind of arrive at what's kind of the pinnacle of success in American capitalism and being a listed company. So that is interesting though, right? Because when you think about today, there's a lot of really big and probably bigger than ever, exciting, fast-growing companies that have decided to remain private. And so when you're talking to a prospective issuer or a company that's making a choice like that, what are some of the factors that they weigh between staying in the private markets or tapping the public markets?
Yeah, no, it's a good question. And look, every company's different. Their objectives, their capital structure, their management team, their strategy, whatever it may be. But I think for too much and too long, we had heard of the benefits of staying private. You can focus on your business, not worry about activist investors, not worry about hitting the quarter and all that. And some of that's true. But when the pandemic hit, we started hearing people talk a little bit more about the benefits of the public markets. And what are those? It's access to capital at market rates, and whether offensively or defensively, through equity, through converts, through debt. And if you look when the pandemic hit, those companies that were public that needed to tap the public markets effectively raised capital at a near zero interest rate. Those in the private markets, and many funded by venture capital firms and others who were under stress at that time, it was like near usurious rates. And so as you think about positioning your business for the future, that's a key benefit. And also, if you're running a business for the long term, the discipline that the public markets bring you from an operational standpoint, from a financial standpoint, and from a governance standpoint, importantly, and you heard about a lot of these private companies and the shenanigans that were taking place there, that gets weeded out very quickly in the public markets. So that sense of discipline, and if you're really building a company for the long term, it's the public markets are a very good option as well.
Oh, that's great. I'm gonna pivot a little bit. I mean, we're talking a lot about markets specifically, but it would be a little bit wasteful, I think, of this opportunity to not get into maybe something a little more operational or strategic in the business community. We mentioned earlier. I mean, you're regularly meeting with the CEOs and the leaders of companies that are the envy of the world, the Fortune 100. What are you hearing from them? I mean, what are their challenges? What are they worried about? What are they excited about?
Yeah, it's one of the great parts of the job is actually spending time with kind of amazing people from business, academia, and government on a daily basis. And you mentioned on the onset, NYSE listed companies, we have 2,400 of them. They're from 47 countries around the world. It's $40 trillion worth of market capitalization, and it's 43 million jobs directly. And so, we want to take their temperature, hear from them what's important to them. And I really think the three things that are top of mind these days are growth, geopolitics, and workforce. And so on the growth side, what's top of mind for most CEOs, I would say, is making sure that there's discipline around costs and cash flows that's going to allow them to fund future growth of their companies, much more so than you had 5 years ago or so when interest rates were real interest rates were effectively negative. So there's that focus right there. Number two is AI. I mean, you can't walk 5 feet anywhere without somebody talking about AI.
So somebody already said EVs earlier today.
Okay, so now we'll move from EVs, we'll transition into
EVs
AI.
And then AI, yeah.
Exactly. But what we're hearing is, there's a focus on it from a productivity standpoint. There's still a hesitation from CEOs about deploying any kind of AI technology externally to their customers as well. You want to control that experience as much as possible, and so it doesn't seem like the technology is mature enough for many companies to put it in front of their clients, but certainly the application internally to increase productivity is there and to ultimately fuel growth. On the geopolitics side, I think companies are reassessing their operating models to respond to influences from external factors. And so I think that's geopolitics, certainly, in making sure that you don't run the risk of getting caught in any kind of geopolitical tensions or trade and investment restrictions that, whether it be sanctions or different actions that are taking place in different countries as well, but also building resiliency into your businesses. You may have heard on the earlier panel talking about diversity in supply chains as well. Just being more thoughtful about how you have kind of business continuity and manage that risk. I think of, if you follow the news recently over the past couple of weeks, there's just crazy flooding in southern Brazil and Rio Grande do Sul, and this is a very industrial part of the country. And so many of these factories that are key contributors to the Brazilian economy and even the global economy, they're still underwater. And so making sure you're thoughtful about mitigating that risk and not having too much concentration in one area that may have some external risk that's there. And I would say the last piece of it is workforce development, making sure there's investment in talent, breaking down silos within organizations, kind of the same themes you've heard for years, but really being reinforced more and more, particularly in this world of remote or hybrid work as well, breaking down those silos, delegating responsibility to and decision rights to the most appropriate level within the organization to really build that resiliency and talent pipeline within the organization. So I'd say those are the three things that are top of mind when you talk to public company CEOs.
Okay, so that's other companies. I mean, as part of the Intercontinental Exchange, you mentioned earlier. I mean, when I think of that, I think that's essentially a very, very sophisticated systems and market infrastructure company that's doing a lot of data processing and processing lots of volumes of inputs. So how does your company think about AI and automation, and incorporating that into your business, which is really kind of facilitating all of our businesses?
I think 232 years later, if you were to rename the New York Stock Exchange, or ICE more broadly, it would be the massively scalable database and infrastructure company, because that's what we are at our core. We think a lot about resiliency. And I'll just give you a stat about the NYSE alone. So we replatformed the New York Stock Exchange's main trading platform 3 years ago. And on any given day, we'll process over 1 trillion unique messages a day with a median response time of 26 microseconds. So think about the fraction of a time to blink an eye. So think about the throughput, the capacity, and the velocity that this information is flowing through your systems. So we also run a market data business, which obviously supplies proprietary and very valuable information to market participants. We've been using AI, which, I don't know, 5 years ago was called software, for a long time. And thinking about how can we, deliver more meaningful insights to the marketplace. I'll give you an example. With data lakes, where you're able to, different participants are able to contribute their data sets to a data lake, and you can offer different permissioning levels as well. We operate on the fixed income side a execution platform for municipal bonds. And we have a lot of data around municipal bonds. And municipal bond investors historically had looked at a very two-dimensional object, a consolidated annual financial report, to make a decision about whether they wanted to invest in a specific municipality or jurisdiction's debt. We said, okay, well, that's very two-dimensional. What about if we take that information, put it in a data lake? What about if we take payroll data we partnered with ADP, one of the leading payroll providers. We take their anonymized payroll data, that's there, and then we bought a company that from a geospatial standpoint, has broken down the United States, actually North America, into 100 meter by 100 meter grids and assessed each grid for 6 different kind of climate risk factors, so wildfire risk, flooding risk, and all that. What if I can put that all in one space, apply some of these advanced large language models and analytics tools, and now all of a sudden I'm an investor, I have a lot more information about the risk and return profile of these assets that are out there. I can see, are the payrolls increasing, which means the tax base is going to be strong, there's going to be more investment attracting more people to that community. Is there risk there that we're going to see a natural, higher propensity or higher likelihood of having a natural disaster? So we've really leveraged a lot of these AI tools to take different parts of our business you never think would have interacted before and bring them together to drive meaningful insights for investors.
Wow, sounds like very powerful. I mean, I could think of all kinds of other applications, right? I mean, if you're going to invest in the local electric utility shares, knowing all those factors would also drive it. I mean, there's just, that's amazing. So this is my fair warning. I'm gonna ask John one more question, then we're gonna open up to questions from the audience. And I see some familiar faces, so if we don't get any questions, we're gonna call some people out. But something that's really kind of fascinated me in the marketplace is the advent and proliferation of passive investing. And so I know you've been involved in some of the ETF product offerings at your company. But if you think about what it means to kind of be in the S&P 500, I think increasingly there's capital flowing based off of index composition and not based off of individual investors making pricing decisions to buy and sell based off of just their analysis of available information. So how does passive investing impact the market, and is there a breaking point where that starts to undermine the market?
It's a really good question. I'll answer it in a couple of different ways. The first is that I'll go back to that theme where at this moment in time, we have a marketplace that works really, really well for large companies. And if you look at top 500 public companies in the United States, and you look at their ownership table, probably number 1, 2, and 3 are Vanguard, State Street, and BlackRock, passive investing index funds. So they are a huge shareholder and investor in large companies, and they're benchmarked against the S&P 500 or another major index that's out there. And so just by being in those indexes, you're going to get that capital flow. If you're a small to medium-sized growth company, you aspire to be in that group because you get that there, and that should be an incentive to try to get there. But we should think about how do we bring more capital into kind of the other parts of the marketplace. The rise of passive investing has been very interesting because, again, it's provided kind of stable ownership to many of the leading and largest companies that are out there. But also, I don't think there's too much, I'm not too concerned about there being too much passive and not enough active managers in the marketplace. The active managers contributing and driving price discovery and writing research and out there. I think it's a balance between the two. When you have too much, historically you saw the passives outperform the actives, more often than not. But when you have more in passive, that creates more opportunity for active and brings that balance and that equilibrium back to the marketplace. But also, ETFs traditionally had been tied to indices, so passive investing vehicles. What we've seen is, we're the world's largest exchange for ETFs. We have about 2,100 ETFs. Last year was a record year for ETF issuance. And what we've seen is, and we've worked very closely with regulators in creating what are called actively managed ETFs, so taking active strategies and putting them in the ETF structure, which brings a lot of benefits from liquidity, tax efficiency, et cetera, versus mutual funds. And so over the past year, I would say, let's say look back 12 months, 70% of the new ETFs that have been issued and come to market have been active strategies. About 30% of the capital that's been flowing into ETFs has been into active strategies versus the passive ones. There is a balance there, and I think the more we can do as an exchange, whether it be through the ETF structure, and we launched the first Bitcoin ETF that came to market earlier this year. We're on the half-yard line of getting a potential approval from the SEC today on Ether-tied ETFs. Our goal is, if we can provide more access to more opportunity with the protections and liquidity of the public markets, we'll leave it to investors to decide how they want to allocate their capital. But as long as it's in that transparent and well-regulated framework.
That's great. So we do have a hard stop here because we have some security clearance we need to do for our next event. But I do think we have time for a question, or maybe two. Anybody in the audience?
Raise your hand. Oh, there we go, in the back there. Perfect.
I like it.
Let me see if I can run. He's got a mic.
Hi, thank you. I just had a question. You talked about how properly regulated markets kind of breed confidence, and then that naturally breeds investment. When you're thinking about that in kind of a global landscape, that's a way that the U.S. has really benefited from these, from those regulations. Is there any kind of stewardship that happens with smaller countries that are not well regulated as they're wanting to kind of build into this?
Yeah, so we work very closely with, about 1/5 of our listed companies are from outside the United States, 1/4 by the amount of market capitalization. Many of them are listed in their home marketplaces, which provides them access to local pension funds, retail investors from the marketplace. So we actually encourage companies from outside the United States to be dually, let me put this, we don't discourage, pardon the double negative, companies from being listed in their local marketplace, because we think that brings a level of discipline and rigor to the local marketplace that may have been lacking beforehand, as analysts and investors in the U.S. market look to the home market to see if there's an arbitrage opportunity or an opportunity to invest there or explore other investment pathways. By the U.S. being the gold standard for the world, we can also deliver that to other marketplaces, which again helps for local market development, creating more opportunity for more people.
That's a great question.
Very good. Anybody else?
I think we're at our
Very good.
time
We're
here.
getting a wave that we've got to finish. We've got a hard stop.
We're getting the wave. Thank you all for joining us. And thanks to John Tuttle. I learned a lot.
Well, and if any of you find yourself in Lower Manhattan with time on your hands and want to come by 11 Wall Street, just stop by, tell them you know John Tuttle, and we'll roll out the red carpet for you. So, thank you.
Thanks, John.